You're concerned a little bit, it sounds like, about where the U.S. stock market is in terms of levels right now. You're looking at the credit markets. What is that telling you?
Am I concerned about the levels of the market?
About whether or not we can advance.
Oh, whether we can advance? No,
Yeah.
I think we can. I think, industrials have sold off as of late, and everyone's concerned about that. But they also had the biggest rise over the last couple of months. So probably a little profit taking and a little concern about what's going on with China. But there's plenty of room to run with this economy and the stock market.
Why would you say then that things are a little bit long in the tooth, and why would you take profits? And where are you taking profits at this point?
Well, I think select areas.
Mm-hmm.
You know, the markets had sold off quite a bit in December. So when you look at the lows, banking's gone up, technology's gone up, industrials have gone up. So if you've made a profit, there's nothing wrong with taking a little bit, because I think the market may trade a little bit sideways over here for the next couple of months.
Mm-hmm. Jay, which sectors do you like here as we are looking at the cusp of some sort of trade deal? We're seeing Chinese stocks advance very sharply. We had the National Congress. We had the Premier outline a lot of big stimulus measures for the economy, which theoretically wouldn't take effect in the economy for another 6 months at least.
Yeah, when we look here in the U.S., we think most of this has already been priced in. I mean, the U.S. stock market has already taken back about 3/4 of what it gave up since the peak of last year. So we don't see a ton of upside here. If you go over to China, though, you see some really aggressive price action, particularly in the technology sector in China. That's been one of the best performing segments in the whole market this year. We think that's just getting started. Valuations in China are still quite low. The PE is at about 11. So the market globally is still discounting China pretty aggressively. But you see stimulus measures, you see a trade deal hopefully in the future. I think that could provide a lot more room to run in China.
I mean, if the market is discounting China aggressively, then they must be really discounting Europe. Theoretically, a boost in China could really help Europe, whose valuations have been very depressed.
Europe has basically had no returns for 3 years in the stock market. So, anything that can accelerate growth in Europe is going to be very welcomed by the market. But we expect in a few months for the ECB to come out and actually revise growth expectations lower. So
it's waiting for Godot.
Yeah, unfortunately.
Dory, if you look at the setup with this stock market rally coming as Treasury yields have stayed very contained, corporate bond spreads also have improved. So you have this kind of, I don't know, is that just telling us that we're in a Goldilocks world and it's a sweet spot for both the Fed and a moderate growth economy, or is that a divergence you have to worry about?
Well, that's interesting that you bring that up of Goldilocks world, because the Fed does seem a little bit more tame right now. And it gives the market a little bit of room to run. Watching those high yield spreads is key, especially as they get tighter. There's a definite correlation with small caps, and small caps have rallied quite a bit. If you look at 30% of the small cap market doesn't make money, so it depends on high yield market, low yields for funding that small cap area, and they've done really well. So I think if we see high yield spreads widen, it could be a little bit tougher on small caps.
You're trimming in small caps, I take it, as well.
Yeah, so in small caps, I'm trying to look for profitable companies that don't need a lot of capital, that are self-funding, and that are showing a little bit more growth at a reasonable price.